This is the Equity Management Academy Mean Reversion Trading Weekend Podcast for June 26, 2022. Gold. Fed Chair Jerome Powell creates massive short squeeze opportunity. Summary. The talk is about how the Fed is going to control the record level of inflation, which is at a 40-year high, by increasing interest rates. Fundamentals always lag the market, so the market has already factored in more inflation and higher interest rates. The fundamentals appear to be out of sync with the technical landscape. We could see some tremendous volatility in the markets over the next few months. Fundamentals. Gold is volatile because interest rates are rising fast. The talk is about how the Fed is going to control the record level of inflation, which is at a 40-year high, by increasing interest rates. The 10-year note hit 350, which is why there was a recent correction in the equity markets. Now the 10-year is down to 307. If we get down below 3%, then the market is already discounting expected future inflation. Fundamentals always lag the market, so the market has already factored in more inflation and higher interest rates. The market appears to have already taken into account the Fed's talk of raising interest rates 0.75 points at its next meeting. The only one who knows where things are going is the market, Equity Management Academy CEO Patrick MontesDeOca said. The U.S. dollar has been challenged due to the tremendous amount of stimulus that came into the market in response to the pandemic. The Fed balance sheet hit $9 trillion. The fundamentals appear to be out of sync. We could see some tremendous volatility in the markets over the next few months. With debt reaching $30 trillion, rising interest rates are already putting pressure on the tail end of the debt, especially those who are heavily leveraged. Every 1% increase in rates on the $30 trillion is $300 billion in increased payments. The war in Ukraine is devastating the supply chain and driving up food and energy prices. The Western economies are under great stress due to the war and disruption in grain supplies from Ukraine and energy from Russia. The underlying fundamental picture is pretty bullish. The Fed is in a dilemma about how fast they need to increase interest rates to catch up with inflation. However, the market has already raised interest rates, doing the Fed's job for them. It's just a matter of time before rising prices and rising interest rates hit other assets, such as precious metals, but also anything that is financed, such as shipping rates, housing, car purchases, and so much more. Even if we have a 3 or 3.5% yield, if inflation is at about 10%, we still have a negative yield in relation to inflation and the purchasing power of the U.S. dollar. The Fed cannot raise rates aggressively because it will destroy the world economy. That defaults will ripple around the world. The challenge is to keep rates reasonably close to the market rates while not crippling the economy. It's a fine balancing act. Wheat and other commodities. Wheat came down from 1363.5, which was the March high, when Russia invaded Ukraine, and has been volatile ever since. On May 18, it hit 1280 and reverted back down to or below a 61.8% retracement of 974. The correction of the first leg might be reaching the level where it will revert again back up. This sort of movement has happened across the board for metals, grains, and energy. Highs were hit when Russia invaded Ukraine, and then the markets came down and adjusted to the reality of the war. Many markets appear to be about to activate buy triggers. Gold and standard deviation. Nikki the Robot provided the weekly gold standard deviation report based on the artificial intelligence of the variable changing price momentum indicator VCPMI. The weekly trend momentum of 1871 is bearish. The weekly VCPMI of 1844 indicates a bearish price momentum. A stop above 1844 stop will negate the bearishness to neutral. If short, take profits at the buy 1 and buy 2 levels of 1805 to 1767. If long, take profits at the sell 1 and 2 levels of 1881 to 1920. Gold has been and has seen a lot of volatility. It has stabbed into an area of accumulation as supply begins to come into the market. We have activated a buy trigger and are long the market on a close above 1826. Every time the market has come down into these levels, the market has reverted. The VCPMI predicts that if the market reaches a buy level, then it is likely to revert back up towards the mean of 1844, which is the weekly average. The yearly average is 1840. The market is nearing the yearly average. On the 16th, we hit 1861. Since gold is trading below the monthly average of about 1849, the market is in a bearish price momentum. This area appears to be important for gold. By identifying the area where the weekly and monthly trends come together. Overall, the market has factored in rising rates and the war in Ukraine. Now we are waiting to see what the actual damage will be and whether the market factored in the right amount. Mortgage rates have almost doubled in 6 months, but time will tell whether it is the right amount as interest rates rise and the war continues. It's going to be really difficult for interest rates to go higher, MontesDeOca said. The economy needs interest rates to go down, which is the opposite of the fundamentals. If interest rates do go down, we are going to see a massive move to the upside in commodities and across the board.
Thank you for listening. If you want to learn more about what we do, please go to the Equity Management Academy, EMA2Trade.com, or listen to any of our previous episodes.